and welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake, Humboldt, and Ankeny, Iowa. Well, how are you today? Hope you're doing well. Taking a little bit of time for yourself. Today, we're going to be discussing a all-important question that many of you have asked over the years, which is, what are you going to give up making the transition from growth to fixed income? You know, anytime we make a big financial decision, it can be scary. There can be a lot of concern and worry. Are you making the right decision? You want to be as informed as is possible. And as a financial advisor and a fiduciary, today I want to answer those questions for you. I know that over the course of the last couple of decades, you've heard me speak many, many times, even in my book, The Capitalized Retirement, about the merits of fixed income. But we want to answer the question specifically today. What are you giving up when you make that transition from growth to fixed income? And I think that that's an important question to ask. I think it gives you a basis of being able to make a more informed decision. Now, if you're brand new to this program, I encourage you, take a look around. Go to our website, johnsonwim.com, where there's an entire archive of past podcasts and radio shows. There's white papers that you can pull up and you can read and become more financially literate. It seems as though as we age and we get older, things go faster and things can get past us. And we want to be up to date on what it takes in today's marketplace to stay in the front of the row. We want to be able to identify what are the challenges that lay ahead as we retire and we continue to age. All of those things are addressed in the white papers and the past podcasts and radio shows. And so I encourage you, really take some time to sift through those. If you're a reader, I also encourage you to get a copy of my book, The Capitalized Retirement. It's affordably priced. It's available at all major book resellers. And it's something that not only can you have tangibly in your hand, that you can read through, you can underline, you can highlight, you can go back to it. But when you're done, you can also pay it forward. You can give that to a friend or a family member, someone that you think that it would help to encourage them to look truthfully at fixed income and making that transition. So let's get down to today's topic. Anytime we're making a decision to make a change in our life, we're giving something up. There's no question about it. You know, if I decide to eat healthier, I'm likely going to be giving up eating garbage food. If I decide to, transition to a sports car for more speed and excitement, I may be in some ways giving up safety. If I make a transition to starting a family and having children, well, I'm giving up sleep for not years, but decades probably. There's always going to be a transition which requires us to give something up. And oftentimes in today's society, giving something up is always looked at in a negative way. Well, today we're going to be addressing this issue. What happens when I make this transition from fixed income, or rather from stocks and growth, to something like fixed income? What am I going to have to give up? Well, the first thing that I'm going to suggest that you're going to be giving up is a big one. It's going to be insufficient diversification. You can only imagine in nearly 25 years of being a financial advisor, or actually more than 25 years now, I have looked at literally thousands of portfolios. Individuals that have mailed their portfolios to me, individuals that have dropped them off, individuals that have brought them in. This is just a part of being a financial advisor and looking at the various different models and all the various different accounts and the various ways of investing. And one of the things that is a very consistent, I would say, thing within portfolios today is the fact that there is such an insufficient diversification. Now, you may be thinking to yourself that you're plenty diversified, and you may be correct. You personally may be very diversified. But the reality is that when you look at a portfolio and you've got American funds, 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 American funds. Well, yes, you may have various different asset classes, but you're not truly diversified, not in a meaningful way that I would want you to be diversified if you were my client. Just because you have small cap and you have mid cap and you have large cap doesn't mean that you're diversified. It certainly doesn't mean that American funds is the very best in small cap, the very best in mid cap, and the very best in large cap. Diversification is one of these things where we technically and truly need to have separate asset classes. They need to be well managed, and they need to be designed on purpose to be able to handle the influx of things that happen within the economy and the stock market. And oftentimes, I will find the average portfolio, which is weighted 80, 90, sometimes more in percent towards growth, all focused on stocks. And it's almost as if having fixed income within the portfolio is a bit of an afterthought. And I think oftentimes that stems from this idea, this general concept that fixed income isn't really a thing that creates growth. But the reality is, if I put you into a stock that every single year produced 5% in growth, would that be considered growth? If it went up every single year by 5%, would you consider that to be growth? And the answer for most individuals would be absolutely. Well, let me ask you, what's the difference between a stock going up by 5% and you getting paid 5% in real income every single year? Is there any difference whatsoever? Now, there are technical differences in that. One, I can spend a dividend. I can't spend growth off from a stock. And that's a big one. That's a big one. And maybe you haven't thought about that, but the reality is that you can spend growth. You see, you have to sell the shares in order to be able to realize that growth. If your house has appreciated over the course of time, you can't spend that. It doesn't change your life in any tangible way. The only way it's going to change your life is if you sold your home. And then you could, of course, realize the growth, and then you could spend the growth. But then all of a sudden now you have to ask yourself, well, where am I going to live? And so the reality is that we have a great deal of insufficient diversification within most of the portfolios of Americans today, especially those that are transitioning into retirement. And fixed income can help you better diversify. Do you have to make 100% of a transition from growth to fixed income? And the answer has always been no, you do not. The fixed income world is not the silver bullet. It is not the all-encompassing magic pill for individuals. It's never been that way. It never will be that way. It's close to perfect, but it's not perfect, and neither is anything else. And so the reality is, if we truly want to diversify our portfolios, sitting down with a true fiduciary who has an area of expertise within the fixed income world is going to bring to you another level of skill and another level of diversification that you very well may be missing. What's another thing that you're going to be giving up if you make this transition from, say, growth to income? Well, this is a big one, and it's one that all of you, I believe, absolutely deserve, and that is you're going to give up the worry over stock market volatility. Will you give it up entirely? Probably not. If you are a worrywart, as my mother would have called me when I was really little, the reality is that you'll probably always be a bit of a worrier. But when you diversify and you begin to make a transition into things that have more contractual components, things that are going to be more consistent, things that are going to be providing you a very reliable, steady source of income, what you're going to find is that you have less fluctuation within your stock market portfolio or within your portfolio in general. Why is that? Because fixed income isn't going to have the ebb and the flow that, say, a stock will. It's going to have more of a consistency. Is it going to be more on the boring side? Absolutely. And you know what? As we age, we get older, we get into retirement age, maybe excitement is one of the things that we no longer really want or desire in our life. When we have the security of a paycheck, sure, it was okay. It was fine to be able to take on and see ups and downs of 30, 40, 50%. That's okay. We still had that paycheck to rely upon. But once we get to retirement, we get into retirement, now we no longer have that security, that safety net of a paycheck every single week or every 2 weeks. That excitement, that kind of loss, the kind of volatility really is quite unsettling. And so one of the things that I've seen people give up as they make that transition to fixed income is the worry. They realize very quickly that they just simply don't have the losses, they don't have the ups and the downs that they were so very used to when they had nothing but equities within their portfolio. What's another thing that you're going to give up when you make the transition from growth to fixed income? Well, I would say loss of time. And this is probably one of the biggest tangible things. When you have a stock market portfolio that is absolutely chock full of stocks and mutual funds and index funds, you have a lot of heavy exposure to equities. And all of a sudden there's a drop of the shoe and the stock market drops. If it becomes a very long-term systemic loss, like we have seen multiple times before within the stock market, where stock market corrections can last 2, 3, or more years. The reality is that oftentimes individuals who are at that point retired, they put their plans on hold. They put their vacations on hold. They put their renovations on hold. They don't like the idea of having to sell shares at a loss in order to be able to pursue those plans, whatever they are. And they'll say, well, we should probably just go ahead and wait to see how things turn out. We should wait a little while for things to quiet down, for our portfolio to recover. My friends, that's one of the worst things that you could give up in retirement is your time. Your time is, aside from your health, one of the single most valuable things that you have. And oftentimes people tend to forget that when your broker, your stock portfolio advisor puts you into all of these heavy equities, they're not asking you just to risk your money. They're asking you to risk your time. Because trust me, human nature being what it is, being a student of human nature and watching and observing it in my career, I can tell you when the market is down, things are volatile, you're not going to feel as good about spending money as you would otherwise. And so when you make that transition from, say, growth, which carries with it a high degree of risk and volatility and potential loss, to now fixed income, where you're getting a consistent, steady income production, and even if the value of your holdings shrink, the income still continues. That's freeing, that's liberating, that gives you a sense of peace to be able to go ahead and pursue furthering your plans, because you know that you're going to have the income to be able to do those things. So think about that. Being able to keep your time and not give it up because of a stock market correction or a stock market jitter, that is a very valuable thing. What's the fourth and final thing that you're going to give up making that transition from growth to fixed income? Inadequate income. Now, I know that sounds very, very blasé, but the amount of individuals that I have met over my time as an advisor who never realized that they could have 3, 4, maybe 5 times the amount of income that they were currently pulling off from their portfolio because their financial advisor had put them so heavily into equities that they really weren't producing anything in dividends, or at the very least, they were producing dividends, but the fees within their portfolio were eating up all of the dividends. And so in this particular case, we want to make absolutely sure that if we're going to be making a transition from working to retirement, And we've spent years, maybe decades, planning what we're going to do when we make it to retirement. This is what we're going to build. This is where we're going to go. This is the trips we're going to take. Well, that you have adequate income. Income to be able to do that. What's the number one question that I get as an advisor, that all of my advisors receive from new individuals? Matthew, do I have what it takes to retire? That's the number one question, and maybe that's a question you've been asking. Maybe that's a question that you can feel good about answering today, saying, absolutely, I've got enough money, look at where the stock market's at. And then a month from now, the market is down, and you're thinking, oh, well, maybe I should continue to work another 6 months. You see, my friends, that's the stock market dictating your decision making. That's the stock market dictating your retirement. And, call me strange, but if I'm going to make a decision to retire and I'm going to finally hang up my shingle, the last thing I want is Wall Street dictating what I get to do in retirement. And this is the reason why I say you're going to give up inadequate income. When you have a stock-ridden, stock-heavy portfolio, that's fine when you're younger, you're on the accumulation stage, you're trying to grow and put points on the board. But the reality is that once we get to retirement, now we want to be able to enjoy the fruits of our labor. We want to be able to enjoy all of those times of stress and, and anxiety when the stock market was down. We want to be able to have all the income that we want, and then some, to say it the way a good friend says it, to have more income than I need so that I can retire and I can do all the things that my heart desires. Because guess what? You are going to wake up one day and you're going to be too old to spend that money. You're going to be too old to really enjoy it. And so income is a big deal. And having, $1 million portfolio, but only producing, say, $20,000 in dividends when you could have $60,000 in dividends, well, that's going to make a tremendous difference in your life, my friend. And so what are you going to give up when you make that transition from growth to fixed income? Inadequate income. I want you to have more than adequate income. I want you to have more income than you need, more income than you would expect. So if you've been on this edge, where you've been teetering, kind of thinking about fixed income, it makes all the sense in the world, but you're just afraid that you have to give something up. Well, there's not many things that you have to give up, but the things that you do give up are, in my opinion, worth giving up. Does it mean you have to abandon growth altogether? Absolutely not. Anyone that says they have to give up growth in order to be able to transition into fixed income, well, they're just not giving you good advice. You absolutely can maintain a portion of your portfolio in equities and growth, and you can have a good time in that corner of your portfolio. But now it's about making purposeful decisions that are going to help you take that bucket of money that you've worked so hard to build and grow and compound and make it do something for you, something that you can draw from every single month without the worry, the anxiety of the stock market, without the worry and the anxiety of what's going to happen if the market drops, without having to put your life on hold, and all the beautiful plans that you've maintained and that you've accumulated over your working career that you want to accomplish when you're in retirement. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.